The exchange rate of Indian rupee against major currencies like US dollars is influenced by complex interplay of domestic and international factors, including government policies, global economic conditions, and market sentiments. Understanding these factors can provide insights into the dynamics of the Indian rupee value and its fluctuations. The basic economic fundamentals such as inflation rate, interest rates, and economic growth indicates significantly influence the Indian rupee exchange rate. Generally, a country with a lower inflation rate exhibits a rising currency value as its purchasing power increases relative to other countries. In the case of India, a lower inflation rate compared to the world average can bolster the INR value. The Reserve Bank of India sets interest rates to manage inflation and control the flow of foreign capital. Higher interest rates provide higher returns on the investments in Indian financial assets, attracting foreign capital and causing the Indian rupee to appreciate. Strong economic growth attracts foreign investments into India, requiring investors to buy Indian rupee, thus increasing value. Conversely, if the Indian economy is struggling, it can lead to a depreciation of the Indian rupee. Current account measures the trade balance, net income of foreign investments, and net transfer payments. A current account deficit occurs when a country's total imports of goods, services, and transfers exceeds its total exports. Indian current account balance is critical factor for the Indian rupee exchange rate. A larger deficit exerts downwards pressure on the government as well as Indian rupee, as it means India is buying more foreign goods and services that it sells, leading to higher demand for foreign currency relative to Indian rupee. FDI brings capital to India, strengthening the Indian rupee as foreign investor convert their currency into Indian rupee to invest. Similarly, foreign portfolio investment in India stocks and bonds can lead to the appreciation of the Indian rupee due to the increase in demand of currency. However, these flows can also lead to the volatility in exchange rate, as they can quickly reverse based on the global economic conditions and investors' sentiments, government spending, and taxations. Policies can influence economic growth and inflation, thereby affecting the Indian rupee value. A higher inflation deficit can lead to the depreciation of Indian rupee, as it may indicate excessive government spending without equivalent revenue, uh, potentially leading to the higher inflation. Tariffs, trade agreements, and regulations can impact the trade flows, influencing the current account balance and consequently in the Indian rupee exchange rate. The RBI occasionally intervenes in the foreign exchange market to prevent excessive violation in the Indian rupee value, such as interventions can directly impact the exchange rate. Global economic trades and even including economic policies of major economics, geopolitical tensions, and international commodities prices and significantly impact the Indian rupee. Policies that affects the USD, such as changes in interest rates for the Federal Reserves and fiscal policies, can cause significant movements in USD and Indian rupee exchange rate. Geopolitical events can lead to increase the volatility in global financial markets, impacting the flow of capital and investor risk appetites. During these times of uncertainty, investors might prefer safe haven currency like the USD, leading to the depreciation of India. India is large importer of crude oil. Fluctuations in oil prices can impact Indian trade balance and consequently the Indian rupee value. An increase in oil prices can worsen the current account deficit, put pressures on Indian rupee to depreciate. Overall, the exchange rate of Indian rupee against the major country currencies is subject to the complex interplay of domestic policies, economic fundamentals, and global market dynamics. Thank you.